Welcome to Talk Tickers, the show that really cuts through the noise of earnings calls to bring you the insights that truly matter for experienced investors.
Great to be here.
Today, we're diving into Southside Bank Shares Inc.'s second quarter 2025 earnings.
That's ticker SBSI for those following along.
Right. Now, on the surface, Southside delivered some, pretty solid beats on key financial metrics.
Yeah, it looked good at first glance.
Exactly. Yet the market's reaction on the day of the release was surprisingly subdued, almost negative.
It definitely didn't pop like you might expect after those numbers.
Right. So our mission today is to really unravel that divergence. We'll extract the crucial nuggets of knowledge from their July 25th call, not just what happened, but why it matters to you.
Let's do it. Go beyond the headlines, dissect the drivers, the loan book nuances, and what management's really signaling for the rest of 25.
Okay, let's unpack this fascinating dynamic. So straight into the results snapshot.
Yeah, let's lay out the raw numbers first, because they were impressive.
They really were. Southside Bank Shares delivered a strong second quarter. Their GAAP earnings per share, EPS, came in at $0.72.
Which beat the consensus of $0.69.
Yeah, by 3 cents, a solid 4.3% upside surprise.
Not bad at all.
And on the top line, bank net revenue reached $68.84 million.
Also a beat there against the $67.9 million consensus, about 1.4% better.
So decent beats on both top and bottom lines.
And what makes it particularly interesting, like you said, is despite these strong results, the stock saw a notable dip on release day.
Yeah, it signals that the market was perhaps scrutinizing other elements, right?
Absolutely. Digging deeper, we saw net interest margin, or NI. That's on a tax equivalent basis. It actually expanded by a healthy 9 basis points.
9 basis points, quarter over quarter. That's significant.
It is. Hit 2.95%. And that drove net interest income up slightly by 0.8% quarter over quarter to $54.3 million.
Okay, so NIM expansion, a definite positive in this environment, shows good cost control, efficient operations.
Exactly.
And what about the balance sheet, loans and deposits?
Both grew. Total loans increased by about $34.7 million quarter over quarter, reaching $4.6 billion.
Okay.
And deposits also saw healthy growth, up $41.1 million.
Good to see both sides growing. And credit quality, always key for banks.
Remained impressively low. Non-performing assets, NPAs, were just 0.39% of total assets. Pretty stable.
Wow, okay, so fantastic numbers across the board, really, which just deepens the puzzle of that market reaction. What was the market missing or, maybe overemphasizing?
It's a great question, and that brings us right into the deep dive. Let's start with that NIM expansion, because it wasn't just luck.
Right, it was strategic.
Definitely. That 9 basis point increase to 2.95% was a highlight, and management said it was primarily driven by a decrease in deposit costs.
So actively managing their funding side.
Precisely. Think about it. In this rate environment, managing funding costs is paramount. They've been working to optimize that deposit mix, shedding some higher cost funds.
So this isn't just passively riding rate moves, it's proactive management. What else did they highlight for the NIM tailwind? Looking ahead.
Well, beyond just general cost reduction, a key factor was the repricing of certificates of deposit CDs. And management specifically pointed out that strong loan growth late in June should also help NIM into Q3.
Right.
But the real kicker, the sort of built-in tailwind for the rest of 2025, they have about $430 million in CDs maturing and set to reprice lower in the next 90 days.
$430 million. Wow. That's substantial deposit pricing relief coming down the pike.
Huge. It'll flow right to the bottom line pretty much regardless of what the Fed does next. A significant internal catalyst.
Okay, that's a powerful story on the NIM front. Now let's pivot to the loan portfolio dynamics because this is probably where some of that market skepticism crept in.
I think you're right. New loan production for Q2 was actually incredibly robust.
Yeah, I saw that number, $293 million.
Yeah, roughly. Which is way up from $142 million in Q1, almost double.
That usually signals strong momentum.
It does. But this was partially offset by substantial loan payoffs.
How substantial?
Around $200 million, and that excludes regular amortization.
Okay, $200 million out the door. What kind of loans were paying off?
About $150 million was commercial real estate, CRE, across different property types.
Okay, CRE payoffs, maybe not entirely unexpected in this market.
Perhaps not. But there was also an unexpected $50 million payoff in their oil and gas portfolio.
Oil and gas? Why? Credit issue.
No, actually the opposite. It was because a private equity firm acquired one of Southside's customers. So a successful exit for the client, which meant the loan got paid off early. Good problem to have, technically.
Ah, Okay, so not a red flag on credit, just an exit.
Right.
So even with those big outflows, they still managed net loan growth.
They did. Net growth was $104 million, but most of that came right at the end of the quarter, last 2 weeks of June.
Okay. But this higher payoff activity must have impacted their outlook.
It did. Management modestly trimmed their full-year loan growth guidance down to 3-4% year over year.
And that might be the head scratcher for the market, right? Robust originations, strong pipeline, but guidance gets trimmed. Signals maybe retention is tricky.
It could be interpreted that way. It's probably a prudent adjustment given what they actually saw in Q2. But they were quick to emphasize the pipeline remains very strong.
How strong?
Exceeding $2.1 billion now, up from $1.9 billion in Q1.
Okay, that is strong. What's their usual close rate on that?
Historically, around 25-30%. So potential for solid growth is still there.
And what about the mix within that pipeline? Are they still pushing that C&I initiative?
They are, and it's gaining traction. Commercial and industrial C&I now makes up about 30% of that pipeline.
Up from 25% last quarter.
Exactly. And it's not by accident. They specifically mentioned adding 4 new C&I relationship managers in Houston in the first half of the year.
So a clear strategic push to diversify away from maybe too much CRE reliance.
Seems like it, especially since management also noted increased competition out there.
Oh, from who?
Particularly from debt funds, apparently offering pretty aggressive spreads and higher leverage.
Ah, the non-banks. Okay, so diversifying into C&I makes sense strategically. Yeah. But let's talk credit quality again. That NPA number was low, but any concerns under the surface?
Honestly, the overall picture looks really strong and stable. NPA's at 0.39%, like we said, basically flat quarter over quarter. Very healthy.
And the concentration, is it spread out or?
Actually, it's primarily concentrated in just one single large multifamily construction loan.
Okay, one loan. The one they moved to non-performing in Q1.
That's the one.
And what's the story there? Is it troubled?
Management was pretty reassuring on the call, said it's well secured, it's got positive leasing activity happening.
Okay.
And they expect it to, quote, exit the bank by year end.
So it sounds like a resolution is anticipated. Not a long-term problem, hopefully.
Doesn't sound like it. More temporary classification than deep distress. And remember, that $50 million O&G payoff, that actually significantly decreased their total oil and gas exposure. It's down to just $53.8 million now, or only 1.2% of total loans.
Wow, that's tiny. De-risking, essentially.
Pretty much. And classified loans also decreased nicely, from $67 million down to $55.4 million in the quarter.
So all signs point to pretty disciplined credit management.
Okay, what about the other side of the income statement expenses and capital?
Right. Non-interest expense for Q2 was $39.3 million. That was up about 5.8% from Q1.
An increase there. Any reason?
Yeah, there was a specific item, a $1.2 million write-off and demolition cost for an existing branch they're replacing with a new building.
Ah, okay, so a one-off, more like a capital project expense hitting the P&L.
Effectively, yeah. Management guided that the expense run rate should stabilize around $39 million per quarter for the rest of 2025.
So controllable going forward. An efficiency rate.
Actually improved. The fully taxable equivalent efficiency ratio dropped to 53.7% from 55.04%.
Getting more bang for their buck. That's a positive trend.
Definitely.
Taxes, buybacks, liquidity. Tax rate was about 17.8% for Q2. They estimate 18% for the full year. On buybacks, they were active, repurchased over 424,000 shares in Q2 at an average price of $28.13.
Returning capital. How much is left on the authorization?
About 156,000 shares still authorized, and liquidity looks very strong. Available lines stand at $2.3 billion.
Okay, plenty of flexibility there. So let's circle back to the puzzle. Solid results, and a tailwind, good credit, buybacks. Why the muted market reaction?
That really is the million-dollar question, isn't it?
It seems like it. That immediate 1.7% stock drop on earnings day suggests the market maybe got hung up on those CRE payoffs.
Could be. Or maybe that slightly trimmed loan growth guidance, even though the pipeline looks strong.
Perhaps overshadowing the positive NIM story and management's generally upbeat tone.
It's possible. Markets can sometimes fixate on one or two metrics. If we connect this to the bigger picture, Southside's strategy seems clear, right?
Yeah, it looks like refining the balance sheet, pushing for higher margins, managing risk tightly.
Exactly. And that C&I build-out, the CD repricing opportunity, those are key internal catalysts that, maybe the market is underappreciating right now.
And didn't they also talk about the Texas market consolidation?
They did. Management sees opportunities there. They're actively looking to pick up talent, potentially from out-of-state banks coming into Texas. And they kept the door open for strategic M&A if it fits their goals.
Interesting. A potential consolidator or maybe even a target down the line.
Could be part of the longer-term story. It shows a forward-looking stance.
Okay, so let's frame this for you, our listener. How does SBSI stack up against peers? The regional bank ETF, KRE, has had a decent run lately.
Yeah, KRE is up about 15% over the last 3 months. Southside SBSI has actually underperformed its peers over the past year.
Okay, underperformed longer term, but shorter term.
Its own 3-month return was still healthy, about 11.6%, which actually edged out the S&P 500 slightly.
So recent performance, okay, but lagging the peer group over a year. That divergence between the solid fundamentals we just discussed and that longer-term market underperformance is, well, it's compelling.
It absolutely is. You have this focus on income expansion, stable credit, strategic growth like C&I. Could the market just be overlooking it?
Setting the stage maybe for re-rating if they execute in the second half like management hopes.
That's the key question. Is the market missing something here? Focusing too much on short-term noise, maybe those Q2 payoffs, and not enough on the strategic shifts.
All right, investment committee. Let's put our thinking caps on. Given all these nuances, the skepticism versus the strategy, it raises an intriguing question. How might someone hypothetically approach Southside Bank shares right now?
Okay, let's step into the not financial advice segment here. Purely speculative brainstorming.
Exactly. This is just us thinking out loud based on the call.
My thesis, if I were building one, would be that the market is currently underappreciating that NIM tailwind, especially that $430 million in CDs repricing lower. That feels pretty concrete.
Okay, underappreciated NIM story. What else?
And maybe underappreciating the C&I pivot, too, how it diversifies the loan book. The market seems overly focused on that slightly lower loan growth guide and the Q2 payoffs, possibly obscuring these deeper positive shifts.
Okay, so if that's the thesis, market is missing the good stuff. What's a potential play? Again, purely hypothetical.
Here's a pitch. Maybe initiate a long position on Southside Bank shares, SBSI, but manage the risk, maybe a tight stop loss just below that earnings day low point, say around $29.70.
Okay, long SBSI, tight stop, any hedge.
To hedge it, you could consider a short position on a regional bank ETF, maybe like the KRE.
Why KRE?
Because KRE has recently outperformed SBSI, like we mentioned, but maybe doesn't have quite as clear-cut and imminent a catalyst like Southside's specific CD repricing benefit.
So it's a pairs trade idea.
Yeah.
Betting on SBSI, narrowing that recent underperformance gap against its peers.
Exactly.
Yeah.
Driven by that clear path to NIM expansion and hopefully stabilization of net loan growth as that big pipeline starts converting.
Is there an upside kicker?
Yeah.
Besides just the operational improvement?
Well, the asymmetric kicker could be that Texas banking consolidation theme. If that accelerates, Southside, with its liquidity and stated M&A interests,
Could become an attractive target itself.
or maybe a significant consolidator. Either way, it could unlock value beyond just the quarter-to-quarter operations.
Got it. So this isn't really a bet on like explosive growth overnight.
No, not really. It's more a bet on a fundamental re-rating, driven by disciplined execution, that improving profitability profile,
Yeah.
stuff the market seems to be glossing over right now.
A play on patience and spotting those strategic shifts.
Precisely. Recognizing those internal catalysts that could drive performance and how management is actively trying to shape their future.
Okay, so to summarize then, Southside Bank shares delivered a strong Q2 on the surface, EPS beat, revenue beat, underpinned by pretty impressive NIM expansion and solid deposit growth.
Yeah, but loan growth guidance got trimmed a bit due to higher payoffs, even though the underlying pipeline looks robust and strategic moves like C&I are progressing.
So we'll definitely be keeping a close eye on their Q3 results in October. Need to see that NIM follow through and whether they can convert that pipeline successfully.
Absolutely. Will the market finally recognize the potential and reward these efforts? That's the question for you, the listener, to ponder.
And as always, the information shared here is purely for informational purposes. It is definitely not financial advice. We strongly encourage all our listeners to conduct their own thorough due diligence.
Always do your own homework.
Join us next time on Talk Tickers as we continue to cut through the earnings call noise and uncover what truly matters in the markets.